Kia ora, welcome back to our next video on this Free Phrase channel. This video looks at government interventions on equilibrium. We'll be covering 4 different topics and starting with taxes. So taxes is our first subsection we'll be looking at. The other government interventions are also subsidies, minimum price controls, maximum price controls, and we'll be looking at how all of these impact our equilibrium graph. So we're first looking at taxes. Now this is an amount that is collected by the government from consumers and producers. There are 2 types of tax. The first one is indirect tax, which we call GST, or also known as goods and services tax. This is what we'll be focusing on today in this video. The other type of tax is direct tax, which is called PAYE. Now this is the type of tax that is paid by the consumer who has a job to the government. So businesses who hire employees, employees pay tax in their pay, and this goes straight to the government. So you don't see this in your bank account as a worker. It is taken out before it gets to you. But that is called direct tax. For that reason, so both of these type of taxes do cause a shift in either the demand or the supply curves. So we'll be looking at the first one today, indirect tax. So as mentioned before, it is GST or sales tax. So this is when the government put a tax on something, usually on something that they want to decrease the consumption for. So tax is often put on cigarettes or fizzy drinks or unhealthy food, and we call that a demerit good. And so the purpose of that is to lower the consumption, because if consumers have to pay more, we know that as the price increases, the quantity demanded by the consumer is going to decrease. So that does follow the law of the law of demand, although we don't talk about it exactly like that in this area. So the tax is going to increase the price, and it will move the supply curve as it is an extra cost to the producer, because the producer will pay a part of that to the government. So it works the same as a cost of production to producers. If you think back to our supply paper, the cost of production, so the cost is going to go up, supply will then go down. So in this case though, we don't shift the supply curve to the left, it actually moves vertically up by the amount of whatever the tax is. So we're going to look at this in detail now. So this is an example from your books. You might like to turn to page 141 just to follow along. It might be a bit clearer than this image here. But essentially, a new tax of $1 has been put onto a packet of cigarettes. And so, number 1, so I'm going to color code the parts of the question to make it easier for you. So if we look at the blue lines right now, the supply curve has moved vertically up by the amount of $1, which is the amount of the tax. Now when you move that supply curve, if you first look at the equilibrium point, so we can see that the equilibrium point was originally at PE, which is $12 on our y-axis, and our equilibrium quantity was at 13 down on the x-axis. So if we were to start at that middle point, say 12, we're going to go vertically up. So see, from that 12 point, the next point up is 13, so $1. And then if we go up $1 from every single point on that supply curve, that is how we get our new supply curve plus the tax. So where I've circled $1 tax, that gap between those points is the $1 tax. The next part here we've got written down is the new equilibrium price. So once we've found our new supply curve with the tax included, we label that S tax. So supply plus the tax. we now see that we've got a new equilibrium point where it crosses over our demand curve. So I've circled that with a yellow pen right in the middle there. That's our new crossover. So if we draw dotted lines all the way across to our y-axis, we see that it's been labeled PT, so price after tax, and that is in between $12 and $13. So the price is now $12.50. So that is what consumers pay. Consumers are paying the price for this product, and because of the tax, the price is now $12.50. If we draw a line from that crossover point all the way down to our x-axis, we can see that our new quantity, QT, so quantity after tax, is at 12.5 million. So it's moved from 13 at the original price point to 12.5. So just have a read through that again and make sure it makes sense to you. Alright, so the next part is that we look at the producers. So the producers receive $11.50 after the tax is introduced. Now this is where it gets a little bit tricky. So this was the original graph, and now at the new price, so where we had our $12.50, that supply curve with the tax, and our quantity lines, we use our quantity line, where it comes down and hits our original supply curve. So if we go from our new equilibrium point, go down, and it hits our original supply curve, so I've circled it on the graph there in green, draw a dotted line across to the y-axis, and you'll see there that I've written $11.50. which is in between 11 and 12. That is the price that producers receive. Okay, so producers are going to receive $11.50. Consumers are going to pay $12.50, and the difference, which is that $1, is going to the government. So at the new price, because essentially the producers are still supplying that same supply curve. The new supply curve is just the tax, which is just giving us the new price. So our quantity supplied is still the same at QT. Okay, so that's how we figure out what the price received to the producers is. Alright, so this part is also in your books, so you might like to read along, and it might make a bit more sense if you use your graph and your book at the same time. So whilst the supply curve has shifted vertically upward by $1, the new equilibrium price has not. The reason for this is that producers do not usually pass on all the tax, as they are concerned about the impact on their sales. So for consumers, the price paid before the tax was $12. We can see that on our graph at the equilibrium point of $12. And their quantity was 13. So let's just go back and have a look at that. So at the original price point, we see that it was $12 and 13 million. After the tax, we saw that the price that the consumers pay is $12.50, and the quantity was also 12.5 million. Total consumer spending before the tax was 156 million. So you might need to go back to one of the previous videos if you want to look at how to specifically work out our revenue. But it is essentially the price times the quantity. So initially the consumer was paying $12 and consumers were buying 13 million. After the tax was introduced, consumers were paying $12.50, but the quantity went down to 12.5 million. So as you can see there, overall, there's been an additional $0.25 million just from that tax, and that has now gone to the government. For the producers, the price received before the tax was $12. So again, go back to the graph, have a look at the original prices. So it's exactly the same for the original point. So 12 and 13, that was our equilibrium point. After the tax though, the producers only received $11.50 because remember there was a $1 tax, consumers paid $12.50, so producers received $11. And if we worked out their revenue, $12, which was the original, times 13 million quantity, original, same as consumers because they haven't changed, 156 million. But then after tax, producers are only receiving $11.50 and their quantity went down as well to 12.5 times the dollar tax. All right, so now their revenue has gone down to 143 million.75. For the government, total tax collected. So how this is figured out, 12.5 is the quantity that has been sold. Okay, so if we go back to our graph, along the x-axis there, we can see that the new quantity is 12.5 million. All right, and then the government have collected 12.5 times $1. So they're taking $1 from everyone. So their total revenue is 12.5 million. So we're going to go through a practice question step by step. This is on page 142. The question says, on the graph, show the effect of a $2 tax on junk food. So remember that we're shifting the supply curve because it's like a cost of production. And so to find our new supply curve with the tax, start at the point. So if you look to the graph with the first pink dot right in the middle and our equilibrium point, so that's at $2.50. We're going to go up $2 because that's what the question is telling us, $2 tax. So $2.50 and we're going to go all the way up to $4.50. So I've drawn the next dot up at that $4.50 mark. The next point, $3.50 on the original line, $2 up, $5.50. Coming back down, put $0.50 plus $2, $3.50, and the last point starts at 50 cents plus $2, $2.50. So you can see now those are our new points where I've put the pink dots. The arrows are just showing that I've moved it up by $2. So we now connect the dots. Remember not to draw over the dots, so don't go past the dotted point, which we call extrapolating your data, because remember that means that your data is incorrect, and if you draw past the dot, that essentially means that the data continues, right? So just make sure that we don't draw past the dot. So we label that S plus tax, supply plus tax. And the next part of our question asks us to label the new equilibrium price PT, which is where that new supply curve crosses over the demand curve. So draw the dotted lines across PT, so price with tax, and we do our dotted lines down to the quantity axes and label that QT, which is quantity with the tax. So that is all of those questions now answered. So from the graph, we can look at the new prices before and after, the new quantities before and after, and there's an additional few questions here. So the price the consumers pay before the tax, we can see at the original equilibrium point, PE, $2.50. After the tax, where the new supply curve is at PT, that is what the consumers are paying. So it is now $3.50. Where we had drawn our original quantity line down, the blue line down, okay, so that quantity, we go all the way down where it hits our original supply curve. So I've circled it with the purple color on the graph. We do our dotted lines across, and it, as you can see, it is at $1.50 there. So that is the price that the producers now receive. So back to the question, the price producers received before is $2.50, that was our equilibrium, and after is $1.50. Alright, so that's how you find what the producers receive. And then another little trick is that should be the difference between your tax. So if producers receive $1.50 and consumers pay $3.50, that is correct because we've got a $2 tax. Quantity purchased before the tax, that was our equilibrium point, and I've circled that QE. You can see there 150,000. After the tax though, our quantity goes down where I've circled it again with the blue, down to 100,000. And then the next part of the question, explain the immediate short-term effect that the tax has on consumer demand. So essentially, we can see that the demand's gone down, so they're going to buy less because they're paying more. This could mean that they switch to an alternative. So for example, if the price of coffee went up, you might switch to hot chocolates because it is cheaper. And then the last question, explain the effect that the tax has on producers. So there's more tax going to the government. The government could then use that extra income for better healthcare. And producers that create healthier products, their production could increase, or the producers might shift to a healthier option. So in this case it's junk food. They might shift their production to wraps, salad wraps for example. That could be a flow-on effect. Okay, so that concludes first little part of the section. So that is only about pages 142 to 143, and that is about indirect tax. So remember, we're working from this book here, not the purple one just yet. I hope that was helpful, and I'll see you next time.